Uh, uh, yeah, I was awarded the Corporate Risk Manager of the Year by Think Business in July this year. I'm an expert in governance, risk management, compliance, and audit, currently serving as the internal audit manager for ABSA Life Assurance. I'm a director in 2 schools, Mikisa Group of Schools, and then St. Mary Magdalene Gidage Secondary School. Of course, I'm a member of the Institute of Risk Management, ISPAC, and Women on Boards. Yeah, so welcome directors to this discussion today. It's a topic very close to my heart. I've been doing a lot of risk management work recently, and I'm happy to be talking about risk governance today. So I'll start with the extract from King 4 report, because we all know that when you talk governance, Marvin King is one of the fathers of governance. So I wanted to just speak and base my discussion on the King 4 report, where he has defined the responsibilities of directors, one being on providing the strategic direction, then approving policy and planning, overseeing and monitoring, and then ensuring accountability. So our conversation today is going to be based on those 4 roles of directors as far as risk management is concerned. And on the right side, I have a few highlights that I picked from King 4 report, which are related to risk management and what your responsibilities as director is. As you're doing the strategy, of course, you have to consider the opportunities and the associated risks of any strategy that you're undertaking. Then we also understand that each of the risks will have positive and negative effects. Sometimes you have you have an example like the current interest rate risk. On one hand, it's an extra income for the organization. On the other hand, it's all the bonds which are available for sale are affected. The valuation is affected. So we really have to think about that when doing strategy. Of course, you also have a responsibility of approving policy documents, specifically on the risk aspect when we talk of risk governance. Then the board is also responsible for determining the risk appetite and risk tolerance. And this is the nature and extent to which of risk that you're going to undertake in pursuit of your objectives. Of course, all the strategies that we undertake are risky, but to what are we willing to undertake? What are our objectives? And then how do we link the risks that we want to undertake to those to that objective, to help us achieve that objective? We agree that we cannot achieve objectives without taking risks, but then we need to define our limits. To what extent can we go? Again, board is not involved in day-to-day operations, so you delegate the responsibility to a management committee that will be involved in implementing the risk, the risk management process. And then your role then becomes oversight in risk assessment to ensure that all the risks are adequately assessed, the correct responses or action to address those risks are incorporated and considered. And then business continuity plans. I think COVID taught us big lessons when it came to business continuity. Most of us were caught unprepared. And then also building the risk culture. Yeah, every decision must be based with a risk assessment. Then, of course, having an independent assurance, having a periodic independent assurance on the effectiveness of risk management, which normally we recommend to do an evaluation every year to see whether our risk management framework is being implemented accordingly. So I'll go to the next slide on risk governance. Well, risk management is very new to most of us. The first time I heard of risk management was in 2007, 2008. I worked in the UK with Deloitte, and I had all my clients who had December reporting deadline go down. So you can imagine 2009, I did not have any clients to work on to audit in the first 3 months of the year. And that's when we started hearing more about risk management, and I developed my interest there to just know what happened to these units that we've been issuing clean reports, and suddenly they've gone down. So of course, we start now talking about those structures that should have been in place to make sure that risks are identified and managed on a continuous basis. So many laws and legislations have given the responsibility of risk management to the board. Yeah. And then the board, in most cases, will have an audit committee and a risk committee. Yeah. In our scenario here in Kenya, because we haven't grown so much as far as risk management is concerned, you find that audit and risk committee is combined. Yeah. But ideally, the two should be separate, considering the complexity of the risks and the highly dynamic environment at which risks are evolving. Yeah. If you look at what has happened, especially in the regulatory space, there's a lot going on. So we need a special committee that will focus specifically on that, so that we are not caught by surprises. Yeah. Of course, the risk committee of the board again is not involved in day-to-day. So you delegate the responsibility to a management risk committee. Yeah. So who sits in the management committee? Depending, of course, on the size of the organization and the complexity of the risks, you will find that some organizations have a fully fledged risk function with the CRO as the head, and you have other risk officers or risk managers below the CRO. And this is mainly in the financial institutions because the regulations were way ahead of the other industries. But then in some organizations, you may find it's just a CRO. So sometimes if you want to have a risk function, you can make use of the senior managers, such as the CEO, the CFO, and any other person like a legal officer who can sit in there to just make sure that all the risks are covered. Yeah. So that's as far as the structure goes, just to make sure that we are all our decisions are supported with a risk assessment. Whether operational, whether strategic, risk should be across the organization. Yeah. So I also wanted us to discuss the ERM framework that was developed by the Committee of Sponsoring Organizations. This is a body that was formed by institutions and some professional bodies, just to develop some frameworks, especially around that time of the Enron saga, the WorldCom. We used to hear about that those years. And then now, the 2007-08 crisis, what happened? So ERM became common then, and we saw a lot of legislation being developed and many frameworks coming up then. So here I'm just specifically addressing the Committee of Sponsoring Organization ERM framework. Again, as you can see, it places a lot of responsibility on the board of directors as far as strategy development is concerned, and then other risk management activities that are supposed to be undertaken. So you may not be there on a day-to-day basis, but at the end of the day, you are responsible. So ensuring that you have the right structures, ensuring that information is getting to you, ensuring that we are monitoring on an ongoing basis. All the frameworks, all the legislations are placing the burden on the directors. Yeah. So why ERM? Yeah. Does it mean we were not monitoring risks before? We were not doing risk assessments before? Not at all. But these were based on departmental level assessments. And from history, you find that risks were being managed on health and safety, the usual that you do for compliance purposes. But now we've gotten to a point whereby you realize each area has to be assessed. If it's HR, a lot of us may ignore the HR process, but there are risks that are sitting there, especially now. If you look at the Finance Act, have we fully implemented the Finance Act? There are other, the other requirements coming up soon, the 2.75%, the 1.5% coming up. Are we ready? So we need to look at it holistically to make sure that we are not missing out on anything, because we may be focusing on the bigger risks, but those small ones that we are ignoring could be the ones putting us at risk as an organization. And if you remember, I don't know whether you saw, there's a letter that was circulating on WhatsApp yesterday from Data Protection Act, the Data Protection Office, of people that have been charged over data privacy. And yeah, the law was put, we have all these people, we have the data commissioner who was appointed, but it's been quiet, yeah? And when things go quiet, we tend to get comfortable until such a thing happens and you all wake up, So risk ERM will help us to proactively manage some of these risks that the organization is facing. And it's only going to get busier and more activity, especially around regulations based on what is happening. Today, we are talking of ESG and sustainability. Very soon, we will see guidelines coming up. Are we prepared? Do we have the do we have the technical skills to understand how this should be applied to ensure that we are providing the right direction for the organization? So, of course, ERM also provides successful risk taking. Some time back, I was conducting a training, and one of the senior managers asked me, so does it mean if I've fully embedded my ERM framework, then I'm risk-free? And I said, of course not, because we're in the business of taking risks. So the more risks you take, the more your chances of growth. But now ERM comes to help you proactively manage events that could go wrong towards you achieving, deterring you from achieving that objective you have set for yourself. So we tend to grow. And there's some research that was done that showed that companies that have embraced ERM are outperforming their peers with big margins, just because they are more conscious. Every day you're thinking of what could go wrong, what could happen, what could affect my objectives, and you consciously put actions and mitigations to make sure that you minimize the chances of those events occurring. Yeah, so which is related to my next point on taking the action. Again, the reputation of the organization. Yeah, this is a big one. The minute people know that some risks are not managed, especially if I can give an example with like the cyberspace, the minute you realize there's a data breach somewhere, yeah, you don't want to deal with that organization, especially if you think of an insurance company that has medical records and there's a data breach. All your information, all your medical records are in the hands of somebody. You don't want to be with that company again. So imagine you're the one sitting as a director in that company and that happens. And of course, avoiding surprises. Many a times you find the directors or somebody saying, I don't want surprises. What is wrong? What could go wrong? I don't want surprises. So having a well-embedded ERM process, then you are well aware of what could be happening and what to expect and avoid surprises, especially for you directors who are not in the business on a day-to-day basis. And of course, it will help you manage such costs as insurance. We've seen like cyber risk policy, whereby you find that when some companies are quoting, they want to first see to what extent are you exposed as an organization. Have you taken the right controls to minimize the cyber risk within your organization? And depending on how well your controls are functioning, then it affects the premium you pay for that particular policy. So it can actually help you reduce some of those costs. Yeah. Here, I just have some of the examples of the concerns that we've had recently. Of course, the 0708 crisis. Recently, we heard of the Silicon Valley Bank. I'm sure, yeah, most of us have heard about it. Closer home, we have the Finance Act, we have cybercrime. This is on the rise. And the IRM, as IRM East Africa Group, we have partnered with the Seriano Limited. Some of you may know Seriano. They are specialists in cyber research, and they do a lot of, they help organizations with assessment of exposure. So we're in the process of developing a cyber risk assessment framework for SMEs, yeah? Because you realize when you're risk management, sometimes having controls can be very expensive. So for an SME, especially for cyber, to have the right controls is expensive, and many of them won't afford. So we are looking for something that is more simple, that's tailored towards SME business. And in 2019, we actually developed one that Seriano has been using with some boards to just quantify the extent of the cyber risk that is within the organization. Then from there, as directors, now you can decide what risks do we prioritize first. So AML is another one that came up recently, actually this month. And it is imposing some penalties on directors. I was surprised that now it's actually a new clause that has been added in the Act. For a corporate, they are charging 20 million. For an individual director or employee is 1 million shillings as penalty. And that may be paid by insurance, yes, but they still, you may end up paying from your pocket depending on how the arrangement is within your organization. Of course, the interest rate risk and the exchange rates, I cannot belabor that. Data protection, I've just mentioned, and of course, sustainability. And these are just examples. There's a lot more. So as directors, every day you go to bed, you're thinking, what could be happening, and you realize now you need to be a lot more involved than you were before, because the world is changing, and it's changing very fast. The risk landscape is changing very, very fast. So here I have examples of some of the laws that gives the directors the fiduciary duties. Of course, depending on the sector, we have Mwongozo, there's a CMA code, governance code, and there are those that are issued by IRA and central bank. It's not a comprehensive list. There's a lot more, but I just thought of highlighting this for you to know that you need to be conscious of the fact that there could be laws coming up. Now we are talking of the disclosures that are required. The sustainability, the Institute of Financial Stability institution in the US, they are coming up with new standards on reporting disclosures that are required as far as sustainability is concerned. That's going to find us home very soon. So we all need to be aware about that. Yeah, so what do you need to be aware of as a director? One is the changing regulatory environment. It's moving and moving with speed. So yeah, you need to be aware and find a way, maybe through trainings, maybe, and it's good that IOD is performing these trainings, and we can have trainings tailored to just highlighting the changes in the landscape that we're operating in as far as corporate governance is concerned. Then ERM should now be an integral part of strategy, culture, and value creation. Yeah. So anything we are doing in the organization, we have to have risk in mind. What could go wrong? Or what can we take advantage of? It's not just the downside, what could go wrong, but also the opportunities that are available for us to take advantage of. Then directors also need to be aware of the significant risks. Yeah? A lot of organizations today or risk functions today have been doing risk management as a compliance requirement. Yeah, I remember when IRA issued the first guidelines in 2013. That's when I got my first job in risk management, and we were doing it because IRA requires it. Not because we really understood why it has to be done, but we need to get to a point whereby we appreciate the concept and be able to identify the key risks. So, because once we have a compliance mindset, then we are not too concerned with what is significant, what is not. So yeah, we need to be more conscious and appreciate the value of the function. I cannot overemphasize this, that we need board members with experience, with the training and intimate knowledge of the business. Last week, I had some regulators from South Africa, the Prudential Authority, and one of the key questions they wanted to know is, are your board members, do they have skills? Are they well trained? Do they have skills to manage specifically cyber risk? Because they've seen what is happening in the environment. So even us as directors, we need to know what's happening in each area, and how is it impacting our business. And in risk, we have a concept we refer to as extended enterprise. You just don't understand the organization objectives, the people, the financials. You also need to think about suppliers, because if anything happens to one of your major suppliers, then it's going to impact your business significantly. So it's important to not only look at the organization where you are, but think of the regulators involved, think of the competitors, think of the suppliers and any other stakeholders that you're dealing with. The other thing is, yeah, of course, is evaluations. I know ideally this should be done on an annual basis, but now there's also it is also important to have an assessment of ERM within the board evaluation. Maybe as a function, not as an individual, but as a function. Are you addressing the risks that are facing the organization satisfactorily? Red flags or violations of existing risk limits. Like I said earlier, a lot of us look at risk function as a compliance function, which should not be the case. So once we develop the key risk indicators, the key performance indicators, we need to be very conscious and constantly review them in the monthly or the quarterly meetings that we are supposed to, where we are getting these reports from. But a lot of us just see a risk report, not get into detail as much, and then you may actually miss out on some key points that could be leading to important information that could affect a key decision. Then board's responsibility should not be passive or not to reliant on management. As you have seen, the responsibility is placed on the directors. So even if a manager makes a mistake, at the end of the day, it's you as a director who will pay that penalty, will be charged that penalty. And then, so it's important to constantly engage with the organization, maybe much more than you have done in the past, because of the way things are changing. I'm in a job where, or the role that I'm playing at the moment, I have a director who's very involved. We have a meeting as control functions with him on a monthly basis. And when we meet, the key question he asks is, what should I be worried about? Yeah, what's going on? When this AML new changes came up, he was concerned. Are we okay? Have we implemented what is required? And some people have expressed concern that he may not be too independent, but now there's a thin line between independence and also being involved. So I think now directors have to be a lot more involved just to know what's happening, because things are changing fast. As much as we are talking of independence, yes, you're still not you're not involved as much day to day, because that's also a question that the regulator asked me last week, and I told him I don't think my director is not independent by asking too many questions, because you see, what's the flip side is if he doesn't ask, then a lot could pass him. So we need to get involved, knowing that the responsibility is squarely on us as directors. So the roles, which is just a summary of everything that I've discussed before, is to ensure that the risk management process is aligned with the vision of the organization. So where are we going as an organization? How is the risk function? How is the risk activities aligned to that vision that we want to achieve? It is important to have the risk function sit in strategy meetings. In some organizations, they are only called upon to, after the strategy is finalized, is when the risk person is asked to come in and do the usual compliance checks. But that's not the ideal way of doing things. Let them be part of the strategy. They're also able to understand the business, and they will help you as directors to manage the risks better. Creating a risk awareness culture, again, is your responsibility to ensure that for every decision that is being made within that organization, then we are doing we are assessing the risks before we make a decision. If you have 2-3 options, what makes you decide which one to go with? It should be that which sits within your risk appetite. It should be something backed up, and not just that you can back up with some information or some risk assessment, and not just a gut feel. Then responsibility should be sitting in the board charter or the risk committee charter, if we have them separated. It's your responsibility to appoint the risk management committee and ensure that they have the right skills and capacity to do risk management. Not just a tick box, but it's somebody who understands what's happening, and someone who understands what they are supposed to do and what to report to you, because they can actually be your weakest point of failure, making you lose out on key risks that you should know. Yeah. Of course, the second thing we talked about is approval of the policies. You will not write them, but the management should bring them to you for approval. Of course, you have to be prepared to make sure that certain key things are sitting well within. Of course, based on the regulations in place, you may be required to include certain clauses, and that's why it's important to have that good knowledge of your business and the regulatory environment to make sure that all the clauses are included within them, the frameworks or the policies that come to you. And then overseeing and monitoring, how do you ensure that you're getting sufficient information? We are in a space whereby people confuse risk and audit. Yeah. And generally, management fear audit, for lack of a better word. You don't want to engage with an auditor because you think they are going to raise issues, because we still have that traditional mindset that an auditor is supposed to come and identify the wrong things and report to the board. So they'll cover up on a lot of things. But how do we ensure that we are getting value? We are getting all the information that we need by having the right monitoring mechanism, the right reporting mechanisms, and for each category of risk. Yeah. A lot of times when you ask the question, what should I be concerned with? Management in most cases will just give you what they think you should know. Yeah. But there could be other underlying factors or other underlying risks that you need to be aware of that will not be brought up. So again, it's important to have that good knowledge of the business. And then, of course, ensuring accountability through the management risk committee, ensuring that they're implementing the risk management frameworks correctly, and everything that is defined there has been followed up. So yeah, and I think that is the end of my presentation. So I just want to leave you with a quote here, that the key to, the camera went on, okay. Yeah, the key to risk management is never putting yourself in a position where you cannot live to fight another day. Yeah, I'll repeat again. The key to risk management is never putting yourself in a position where you cannot live to fight another day. I know many things will keep you awake, but having an effective risk management framework and making sure that is well embedded will give you a peaceful night. So thank you so much for listening to me, and I'm happy to take any questions.
Thank you very much, Ms. Catherine, for the wonderful presentation and insights. Before we go to the next stage, maybe I can just read 2 comments on questions so that we can move to the next stage. We have Mr. Kenneth Masharia saying, please share more information on EML. Did I hear that right? And then I can tally it with Dr. Peter Kitonyo is asking, how can organizations prepare for black swan risks, such as COVID-19? Can boards really prepare adequately for such risk? And he continued asking, what are the key highlights of a risk assessment report, and how can organizations ensure that they have an effective ERM program? How can one tell the ERM is effective? And then we have a good comment from Mr. Michael Muite. Great presentation. Happy to connect on LinkedIn. Maybe Catherine, you can respond to those two questions, and then we can go to the next session.
Yeah, thank you so much, Tatiana. Yeah, so on AML, there's a letter that was circulating yesterday, and the Data Protection Office has charged a few entities on data privacy. One of them was, they've mentioned NIBUS, and I understand what happened there is there was a cyber breach, yeah, and some data was accessed, customer data was accessed. You see the way we use that card, that gives you the points. So there was a cyber attack and the data was accessed. So it's one of the organizations that they are doing an audit on. So it's likely to be charged. I understand that could go up to 5 million. There's a club on Gong Road. I think it's Casavera Lounge or something. That was charged 1.8 million for putting up a picture of a Rivella, online without her consent, yeah. Then there was another school somewhere, I think in Kangemi, that they posted a photo of a child without the consent of the mother, that has been charged another about 2 million or something, close to that. So that letter had listed down all those charges that have been raised, the penalties that have been raised against these people, these organizations. So many of us may think, like when we have marketing events, you have all manner of people coming in for such events, yeah. You as a director, you may not even be aware that there's a marketing activity, because that's a management responsibility. But there you are being charged so much money, yeah, for something you didn't even know, you are not even in control of, yeah. So that assurance from management that they're taking care of such, regulations, to make sure that there's somebody who's responsible and all staff are trained, because a lot of the sources of risks that we see are from staff, yeah. Making sure that the staff are aware about the regulation, because you may just find one of them has taken a video and posted it online, yeah. Next thing, you're getting a letter from the Data Privacy Office that, yeah, you should pay this amount of money, yeah. So the question will be, where were you as a director that you never noticed this? The second question is on Black Swan. And I want to acknowledge that, yes, we cannot say we have done adequately. Yeah, we have adequately managed the risk. Because you see, a good example is COVID. When it came, none of us was prepared. Yeah, I think none of us knew what to do. Yeah, but we can always manage a few risks or a few events from happening as they happen. Yeah. So like when COVID came, we didn't know how long it will go on for, to what extent it will impact our customers, to what extent it will impact our operations. And that's why it's important to engage on a day-to-day basis. Like in my organization, I think there was a daily meeting to just see, okay, so what are the developments now? What can we do? Yeah, everybody has to be involved. The directors have to be involved, because you don't know. It's something you don't know. So try and do your part. Yeah. Remember, risk management is not about eliminating the risk, but to managing it to an acceptable level. So, constant engagement to ensure that you're taking the right action at the right time, and so that you minimize the effects that it will have on the final objective. So that's what I would say. You can never say, no, I've done enough. It can never be enough. But it's to try and do anything humanly possible to control the situation so that you minimize the chances of failing or the chances of not meeting your objectives as an organization. I think the next question was on the risk assessment. Yeah. So we have internal environment. Okay, of course, the organization has 4 components. We have the strategic, the operations, reporting, and compliance. That's everything about an organization. Internal environment means the board. That is the tone at the top. What tone have you set in the organization, in all those components of that organization? So the board obviously determines everything. That's why your directors to direct. Then you have objective settings that are aligned with the strategy of the organization, whether it's a 4, 3, 5-year strategy. So you set objectives. Then that's when now we start the risk management process. Yeah, from identifying things that could go wrong within our strategy. Yeah, so objective setting will list down, these are the things that we want to do. So you identify in each of those strategies what could go wrong, that is, or what could go right. Yeah, remember, it's opportunities and risks. So event identification will identify the opportunities that could take advantage of to help us achieve the objective faster or better or more efficiently, or things that could go wrong that we need to consciously manage to make sure that we have the right efforts, the right actions to mitigate, to reduce the chances of those risks materializing. So that's where we start the risk management process. Then we do a risk assessment. So risk assessment is to look at each of those events and determine what is the likelihood of this risk happening. Yeah. So a lot of times you'll have a risk assessment matrix that will have impact and likelihood. So it could be, the likelihood could be low, medium, or high, or sometimes you may have a 5 pillar assessment, and then impact. This is where now we quantify. If it happens, how much are we likely to lose? So we do the assessment there, and then we come up with mitigating actions. So depending on the resources that the organization has, it may decide, remember, controls are not cheap. Some of them are not cheap, especially in the cyber risk space, they're not cheap. So you may want to decide which one do I want to prioritize. Of course, it is those that have a higher impact on the organization that will tend to make us lose more or deviate away from meeting our objectives more than others. So we need to come up with the reports that come depending on the risk assessment done. Yeah, control activities related to that. What controls are we going to put in place? Information and communication, how we need to have defined what information are we taking to which stakeholders. Yeah. So of course, what goes to management or discussed in the management risk committee does not all go to the board, because you don't need to know everything. Yeah. So we need to have defined what information shall we be giving to the board, and what information can be managed by management, because you don't have time to look at everything. And then monitoring, how often? A lot of times we develop risk registers, which is a register showing these are the risks we have, these are the actions that we have to mitigate those risks. But then what happens? We keep that register in a locker waiting for next year for evaluation. Within that time, guess what has happened? AML changes have come through. We have suffered a penalty. Our register does not have any risk touching on AML. Yeah. So we need to define how often should we monitor, The management risk committee should help with this. How often should we monitor? That register should be updated at all times, such that when I take that register, then I know these are the key concerns I should have as a director. And then I'm more prepared. Should something happen, I can answer to any of them. And then I think that response would also cover the other question on how effective an ERM program, how do you determine whether it's effective? So it should have all these activities well-defined, implemented, and adhered to. So, of course, if it's monitoring, there are some organizations that may decide, you know what, quarterly is good enough for us. Others may decide, no, monthly is good enough. Others may decide, no, depending on the changes for some risks, we want to monitor on a weekly basis. So it will depend on that. So depending on which organization you are in, the risks you're exposed to, the complexity of those risks, then you'll be able to determine how to define each of these within the ERM framework that will have been approved at the board, and then make sure that the risk committee that has been delegated with this duty is adhering to the ERM framework provisions. So I hope I have answered that satisfactorily. Back to you, Tatiana.
Yeah, thank you. We have 3 more comments, or can we go back to the video? Or I just read it out so that as you share the video, we have Director Eric Mudhuri. Please share steps on how board used to set an ERM organization at board level. We have also Dr. Peter Kitonyo. Great presentation. Keep it up, Kate. We have Director Katusia. Good morning, all. Great presentation. Could Catherine expound on that last quote? Is it calling for boards to be conservative? Catherine will answer that. We also have Director Winfred Budi. A great presentation, Kate. Kindly share the presentation later. We shall share the presentation to every director together with the, the slides and the video. We also have Director Sultan. Why do we have a great gap between qualifications, credentials, etc., and reality practicality? Famous qualified experienced directors facing lawsuits, scandal, moral governance, and other evils. We also have Director CB Salim. Thank you, Catherine. Any insights on climate risk? How should the board be prepared to assess new risks that are yet to come? Maybe you can answer those, and then I can read out more comments.
Okay, thanks. So I hope I got them all, but I'll answer then if there's anything I miss out.
Yeah, we can start with Director Eric's question. He was asking, please share steps on how board used to set up the ERM in the organization at board level.
Okay, yeah, so that question for setting up the ERM within board, of course, first of all, you have to have capacity. There has to be somebody who within the team who has knowledge or the skills for risk management. Yeah, because most of us were unprepared. We were using the skills of the chair of audit and risk committee. That's where it will sit in most organizations, because very few have a separate risk function. So first of all is to identify somebody who understands risks. I've attended some board meetings, and when it comes to some of these reports, some board members have nothing to ask or nothing to say or nothing to contribute. So I think first of all is to identify who has the skill, who has the skill, who can handle this responsibility. If there's none, we can train somebody, because like IOD now, one of the trainings we are, like what we are discussing now, you may realize within your board, maybe you don't have somebody with the information on risk management, like the risk management process from identification all the way to monitoring. And you see, without such a person, then you cannot play your oversight role effectively. Yeah. So we can have somebody trained within the board to understand ERM and how it's supposed to be implemented. And then once we identify the person, then the rest is easy, because now as board members, we can, it will sit within a certain committee. Then we develop some terms of reference, and you can even use an external consultant to help you to develop the terms of reference for a risk committee, which will guide now the operations of that committee. And then from there, we'll have now the management risk committee. Of course, they'll also have their own terms of reference, reporting independently to the risk committee of the board. And yeah, I think more of training, but the first point is to identify an individual responsible. If they don't have the skill, then let's train them. Let's come up with the relevant governance documents, and this will include the terms of reference for the committee, the risk policy, the ERM framework, and anything, ERM procedures document that will guide the day-to-day. And any other. We could have the AML policy, you could have the cyber risk policy, and any other risk that we are concerned with. But now, once we identify an individual, they need to be taken through that training to understand what they are supposed to do. Okay. Then the next one was on, we seem to have a great gap where we have people who are, their skills, they have everything, but we are still finding them being penalized. Why? Because there's a lot of developments today, yeah. And also I'd say to some extent the ethical aspect of each person, yeah. Like if you look at what happened during the credit crisis, yeah, subprime mortgage, and people paying, making wrong decisions at that point in time. We've also seen some CEOs consciously paying themselves excess money and taking very high risks. So to some extent, it's on the ethical aspect of the individual, and that's why we do sign the code of ethics every year to make sure that you're taking it upon yourself as a personal responsibility that whatever I do is in the interest of the company and not me as an individual. I think we have seen it, especially in our country. You were to talk about the political side, which I don't like very much. You ask yourself, are they really here for the interest of the country, or is it for their own individual interests? So it boils down to that. And that's why no matter how learned or how skilled you are, as long as you go against the ethical principles that are expected of you as a director, that is still likely to happen. But also the other point is educating yourself on an ongoing basis. Yeah. Like by now, we should be knowing about that AML letter that came out yesterday. You have to have a system that, if you can't get the information yourself, you have to have a system that alerts you or informs you on the current development so that you're not caught unaware of what is happening within your operating environment. Then the next one was on, climate
insights
risk.
on climate risk, yeah.
Yeah, climate risk. Yeah, we had the climate ACS, the Africa Climate Week, early this month. As IRM, we were lucky, we were privileged to be part of the team that was doing the risk assessment for that function. For that project, you were to call it that, or for that engagement. And there's a lot that was coming up, yeah. And the declarations that came out of that, we need to start thinking as directors, how are they going to impact us? Yeah. How much effort should we put in to make sure that whatever the declarations are, we are aligned. And there's a lot still happening. Last week we had the New York Climate Week. So the outcome out of that, it's not all defined. It's not sitting anywhere on a document. Right now, everything is just like at an idea stage. I know most of us are coming up with controls like, oh, let's plant trees. But again, like for us, what we've decided is okay, although that's not related to climate risk, but if you look at ESG holistically, we've just picked on a few areas where we want to do sustainability efforts. Of course, one of them being on climate. So we are doing a lot of tree planting, and you need to be seen to be a force for good. You're doing something to the society. So for me, I'm also thinking it's an area not just for risks, not just climate risk, but there are a lot of climate opportunities that your organization can take advantage of. So as directors, I would urge, if we can get somebody who can train us, it's a new area. If we can get somebody who can train us on how to identify those opportunities, because for me, I think it's more of opportunities than risk for organizations, how you can participate as an organization to contribute to the society. So that would be my comment on that, because depending on which organization you are in, the risks will be different. Yeah, that's how I respond to that. Is there anything else I've missed, Tatiana?
Not really. Comments are coming in very fast, and I can see time is not on our side. We have only 3 minutes left. I think we can share the videos to all the participants later, so that we can just end the session with this Q&A. We have Dr. Peter Kitonyo asking what are the required qualifications for a risk manager. Great presentation from Laura Nyambura. Great presentation. Indeed, risk management is a responsibility for all, from the board to all other levels. And then our Director Michael is asking, you mentioned that control cost quite a bit to implement. For organizations that are small and may not have enough resources, how would you recommend that they start to implement ERM? We have also, kindly forgive me if I haven't read your comments, from Director Kenneth. Thank you for the presentation. It was very insightful. Director Mudhoni Kamere, very insightful with key learning. Thank you, Catherine. We have Sandra. Thanks for the insightful presentation. Ms. Catherine, maybe you can go ahead and answer the 2 questions, because the more comments that are coming in are just for comments and the wonderful presentation. So maybe you can answer to Director Michael in regards to the control cost.
Okay. Yeah, so there's one more that I know I have not addressed. I've just remembered. Somebody asked about this comment that I have, the quote, the key to risk management is never putting yourself in a position where you cannot live to fight another day. Once we don't manage our risks well and something happens, you want to bury your head in the sand because everything has gone wrong and you're thinking, what happened? At the end of the day, all eyes are on you as a director. Where are you? What did you do? Yeah. And you start feeling embarrassed. You don't want to walk around. So this quote is not saying that you should relax. It's saying that, if you manage your risk well, then you put yourself in a position where you can live to fight another day. You can wake up confidently, walk with your head raised that I manage the situation. Yeah. Irrespective of what the issue may be, especially when they go to the media, you can still walk confidently that, yes, I have managed the situation as best as I could. Yeah. So the other one was on the controls and organizations without resources for risk management. So you don't have to have a fully fledged risk function within the organization. We have all these consultants that can assist you. Yeah. When I worked in KPMG, one of the things we were doing is outsourcing. So you may have worked with outsourced internal auditors, whereby you may have an internal audit function within, and then you get an auditor to come and help review, because maybe it's only one person, or you want something more independent, an area reviewed by a more independent person. So same case with risk, you can actually outsource it. Yeah, you can, if you can't afford, get a risk officer that can be the contact person, or even the CFO. If you can't afford the risk officer, then get a consultant who can be coming on regular basis to just check and confirm that the risks are well managed. They produce reports for the board, and it will be a lot cheaper than having a full-time staff member. The other one was on controls. Did I miss that, Tatiana? There's something you said about controls? Tatiana?
Oh, sorry. No. I'm here. Director Michael was asking, you mentioned that control costs quite a bit to implement. For organizations that are small may not have enough resources, how would you recommend that? How would you recommend that they start to implement the ERM?
Yes. So yes. So yeah, of course, some controls would be very expensive. You can imagine, like, if you're monitoring the cyber attacks on your systems, that would be pretty expensive. So you may not afford that. So the easier one is look at cyber risk insurance. Yeah, cyber risk insurance. So with insurances, should something happen, because you cannot completely avoid the risk or manage the risk, then should it happen, there'll be insurance to take care of it. And again, you'll have to assess, and we normally say there are 4 ways of treating a risk. So you can either accept it. If it doesn't have such a big impact on the organization, you may decide, you know what, you will have to have a cost benefit analysis for each control. Yeah, so you may decide to accept. If it's something that you can live with, is fine. There's nothing wrong with that. You can decide to mitigate. And by this I mean you put up now a control. After doing your cost benefit analysis, you can see there's more benefit in having the control than and minimize that risk. So you can develop the control. That's the mitigation. You can decide to avoid it completely. You may decide, you know what, like AIG, at one point they decided they're not underwriting Subarus. That's a risk they decided to avoid. We are just simply not underwriting this book, because if you look at the control, if you have to put up a control and the risks that they're exposed, the control is a lot more expensive. So it's just easier to avoid it. Yeah. Or you may decide to, therefore, treat, mitigate, accept, or transfer. Transfer is insurance now. So you may decide, I live with this risk, especially now we are going digital. So you can't avoid, you have to be digital for the convenience of the customer. So instead of now sitting worrying every day, just insure it. You transfer the risk to somebody else. So should it happen, then they are able to refund you whatever losses you may have encountered when the risk materialized. So there are those 4 key things. So just the key point to remember is the cost versus benefit of each risk should be assessed, of each control should be assessed, and then you can decide of the 4 ways of treating that risk, which route should you go. Of course, that should be aligned with the strategy you have and your risk appetite.
Great. Thank you very much, Ms. Catherine, for the wonderful presentation. Thank you, directors, for your time. I think our time is not on our side. It's 9:04. I know we have other engagements early in the morning. I'm wishing you all the best in your today's endeavor. We shall share the slides. We had a video that we were to share with you, but the comments came in very fast. We had to answer all of them. If you haven't answered your questions, I will share them to Catherine, and all your questions will be answered. Thank you very much, and have a blessed day ahead.
If you don't mind, I can take just a minute, because my video is just 1 minute.
Okay.
Yeah, it will just take a minute, just to emphasize the point, and from IRM.
Miss Catherine, you can't see anything?
Oh, you can't see?
Yeah, the video is not showing.
Oh, okay, sorry. Let me try again. If it doesn't share, then I will just send it to the members. Can you see it now?
No. It's still blank
Okay, then we'll just send it on email.
on email.
Yeah, that's okay.
Okay, great.
Okay.
Thank you so much. Thank you. I think we can close the session now. Thank you so much, directors. We had 70 participants. I can't read all your names, but thank you so much for joining us in. Looking forward to seeing you in our more webinar series that we have them monthly and also the ones that are also chargeable. Have a great day ahead, and feel free to contact us for any clarification and inquiries. Bye-bye.
Thank you. That was fantabulous.
Thank you, Dr.
Thank
Mike.
you.
Thank you.
You're welcome. Thank you. Bye-bye.
Bye. Okay.
Thank you. Bye-bye.
Bye.
Bye-bye. Thank you.
Okay.